Now we have to talk a little bit more about risk, okay? We've just done our sensitivity analysis, right? And it might seem to some of you that the example we just solved suggests that risk is actually not changing the NPV, right? We laid down the risk in the sales of the company, but in the end we decided that the NPV is still the same, right? So it might seem a bit strange, you know, where did risk go, right? Of course this is wrong, okay? Risk is going to affect the value of a project. We like safety, right? We want projects to be safe, so the higher the risk of the project, the lower the value should be, right? This idea has to be true, right? So what we're going to learn now is how do we incorporate risk into the valuation. The reason why risks is hidden, is because we have been taking the discount rate as given, okay? That's really the main reason why we haven't found out risk yet in this course, okay? I've always been telling you the discount rate is 10%, is 8%, is 7%, right? So the idea, and this is a key idea in finance, is that the discount rate should reflect the risk of the project. That is the number that is going to capture risk for us, okay? So what we're going to talk about now is how do we implement this concept, okay? To understand this better, let's go back to Module 3 and think about the internal rate of return again, right? What we learned in Module 3 is that if the IRR is bigger than the discount rate, then the NPV is positive, okay? So you have to compare the IRR of a project with the discount rate. If you're thinking about risk, right, what we're learning now is that the discount rate captures risk. So another way you can think about this statement is that the higher the risk of a project, if a project is more risky, right, then it's going to take a higher rate of return to turn this project into a good project, okay? So to make a project positive NPV, right, if risk is high, you're going to need a high rate of return, okay? So that's an intuitive way for you to think about this relationship, right? Measuring risk, it turns out that measuring the risk of a project, measuring the risk of a company, measuring the risk of an investment is one of the key topics in finance. In fact, you spend a lot of your time in an investments course when you study investments rather than corporate finance. A lot of the course is typically devoted to this topic, okay? What we will do in the next few slides is to do a review. So our course is self-contained, and you know how to incorporate risk into corporate finance valuation, okay? But if you would like a more in-depth discussion, what I recommend is that you have a look at Scott Weisbanner's investments course, okay, which is also available, and it does have a much more in-depth discussion of how we measure risk in finance, and which really is the same ideas we're going to use here to incorporate risk into corporate finance valuations, okay? Let me give you the bottom line first, which you might remember if you took Scott's class already, okay? The way that we're going to measure risk for a company project, for a company, is by using the weighted average cost of capital formula, okay? If you haven't seen this, it's going to look foreign. If you have, it's going to look familiar. That's why I want to do a review of this, in any way. Even if you took Scott's class, I think it might be useful to do a review and think about the weighted average cost of capital from a corporate finance point of view. Okay, it's the name says it all. The weighted average cost of capital is a weighted average, right? You have the required return on debt, and then you are multiplying this by the fraction of the value of the company that comes from debt. Okay, it's debt over value, where value is defined as debt plus equity. Okay, and then you have the required return on equity multiplied by the fraction of the value of the company that comes from equity. Okay, so the E here is going to be the market value of equity. Okay, so it's just a weighted average. What I want to do in the next few slides is to do an example with you. Okay, and I'm going to use this example to review the key concepts. And as we've been doing in this course so far, I want to use data from a real-world company to do this, okay? Specifically, what we're going to do is we're going to compute the WACC for PepsiCo as of June 2015, okay? we need to do this for a certain period of time because, as you just saw the formula, the WACC depends on the value of the company, so we have to measure the value of the company and some of the market data for a specific period of time. But the ideas are the same. You can use the same principle, the same calculation to compute weighted average of capital for any company in any period of time. Okay? Let's start with the required return on debt. The data that we're going to use here is expressed here in this graph. Okay, it's the data on yield to maturities of PepsiCo bonds. Okay, so debt holders in this case they own bonds, right? PepsiCo has issued bonds, so debt holders now own these bonds, and what bondholders get is the yield to maturity. Okay, so this graph shows the yield to maturity on PepsiCo bonds of different maturities. Right? So you can see here the x-axis tells you the years, right? So here at the end, we see that PepsiCo has issued long-term bonds that mature only in 2040. Those bonds have a yield of approximately 4%. Okay? So before we use this data, we have to understand a little bit more about what the yield to maturities actually measure, right? And it turns out that the yield to maturity is just the expected return on the bond. Okay? So you can think of the yield to maturity on a bond as the return, the percentage return, right? As we discussed in Module 3, the IRR is the percentage return. You can think of the YTM, the yield to maturity, as the percentage return that an investor would hold by holding the PepsiCo bond till maturity. Okay? So if you buy the bond today, okay, and the bond does not default, you expect to make 4.2% a year. And default is an important word here, okay? This calculation only works exactly if the company is far away from bankruptcy. Okay? We're not going to have much time to discuss this in this course, but remember that you can only approximate the required return on debt with the yield to maturity for a company that's far away from bankruptcy. So for PepsiCo, this would be a reasonable assumption. It might not be that reasonable for a company that has a really, really high leverage ratio that is approaching bankruptcy. As we discussed in Module 1, the leverage ratio gets too high, the company is going to go bankrupt. Okay? So really what happens is that if the bond defaults, you're not going to get 4.2%, so the true expected return for a company like that is lower than the yield to maturity. Okay? So here's the question for you. We just figured out that the IRR of the long-term bond is 4.2%. Okay? So you buy if you buy the 2040 PepsiCo bond and hold until maturity, your expected return is 4.2%. Let's think about NPV, right? That's the question. What should be the NPV of this investment? The NPV should be 0. Okay? The 0 NPV idea, as we discussed in Module 3, will turn out to be a very powerful, a very important idea in corporate finance, or in finance in general. Okay? It might seem strange, right? Why is the NPV 0? Right? We haven't done any calculation. I just showed you how to do calculations, spreadsheets, formulas. How do I know the NPV is 0, right? It seems like that I have a crystal ball here. Okay? Really what I'm using is a market equilibrium argument. Okay? Think about the following. Suppose the NPV was positive. Okay? The NPV of, picking up, and think about what would it take for you to buy a PepsiCo bond? Okay? If you had the money, right? All you need to do is to pick up a phone, call a trader, or go to your computer and buy a PepsiCo bond. Okay? You should not be making money by that, right? It's very easy to do that. So if the NPV is positive, many investors would be picking up the phone. All the traders would be buying PepsiCo bonds, right? They would be calling their brokers. They would be, just buying and buying and buying, right? And we know from economics, basic economics, that if there is a lot of demand for a product, if there is a lot of demand for a financial asset, the price should go up. Okay? And if a price of an asset goes up, future return should be lower, right? If you pay more for PepsiCo bond today, your return is going to be lower, right? So if the NPV is positive, everybody would be buying the bond. Same thing, right? If NPV is negative, everybody would be selling the bond. Okay? So the only possible equilibrium in the market for PepsiCo bond is one where the net present value is 0. Okay? For a financial asset like a bond that is very simple to understand, that everybody can buy and sell, NPV equals 0 is a very reasonable assumption. Okay? Why are we going over this? Why is this an important idea? Because we're going to use this to estimate returns. Okay? This really is a beautiful idea in finance. Okay? We just learned, right, that 0 NPV is a reasonable condition for many markets, right? What this means is that, remember module 3, right? If the NPV is 0, the actual return, the expected return, should be the same as the discount rate, the required return. Okay? So if the PepsiCo bond NPV is 0, what this means is that we can use the yield to maturity to approximate the required return on that. The return that we measure in the market, okay, is just the return that investors demand to invest in a PepsiCo bond. It's the required return, okay? Right? So that's a very useful idea, because we can use that data to input in our valuation and figure out what the required return on that is. Okay? One more point here. I prefer to use a long-term yield to maturity for corporate finance, and we know already why. Okay? Since we started this course, I've been pushing this idea that corporate finance applications have a long horizon. Okay? We're always thinking about the long term, right? So my suggestion is that we always try to estimate the long-term cost of debt, the long-term required return on that. What this means for PepsiCo is that we are going to use the 4.2% number, which is the yield to maturity on a long-term bond. So rather than use 2, 3, 4, 5-year maturities, we're going to take the longest possible maturity that we have available in our data. Okay? But really, the key idea is the 0 NPV idea, and how we can use that to estimate required returns using expected returns, using actual expected returns.